Before discussing how dividends are taxed, it's critical that you understand what a dividend is. So let's first walk through the process a company would go through when declaring a dividend. This concept is easier to grasp if we consider a very small corporation. Joseph and Jackie went into business together. Upon startup, they decided to incorporate the business and call it Double J Enterprises. They both decided to invest $10,000 in exchange for 100 common shares. Since the company has only issued 200 shares in total, this makes each of them 50% owner. After the first full year of business, they sat down with their accountant to review the company's financial statements. After paying business expenses, including corporate income tax, the net income for the year was $100,000. Both Joseph and Jackie sit on the company's board of directors. Makes sense. They were the only shareholders, so they voted themselves in. As directors, they have a few options with regard to the company's net income. 1, they can pay it out to the common shareholders, in other words themselves, by declaring a dividend. 2, they can choose to retain the earnings within the business to fund future growth. In this scenario, even though Joseph and Jackie wouldn't receive any cash today, retained earnings within the corporation will still benefit them. After all, they own the company, and reinvesting earnings back into the company should increase its value. Or number 3, any combination of these two options. Mature companies that don't have much growth potential may pay out a good portion of their income as dividends. This is referred to as a high dividend payout ratio policy. On the other hand, growth-oriented companies may not pay a dividend at all. Investors generally don't like unpleasant surprises, so large corporations usually maintain a somewhat stable dividend policy. For example, a large company wouldn't want to have a high dividend payout ratio one year and a low dividend payout ratio the next. In fact, there's even a type of share known as a preferred share, which pays a fixed dividend rate. This type of share would be ideal for an investor seeking regular income. Even with common shares where the dividend can fluctuate, the issuer will usually have a stated regular dividend and may sometimes pay an extra dividend in extraordinary profit years. That being said, dividends are never guaranteed. With interest payments on, let's say, a corporate bond, the issuer would get into serious trouble if it missed an interest or principal payment. Doing so would be similar to a homeowner failing to make a mortgage payment, where it wouldn't be long before they faced legal action. However, when it comes to dividends, the board of directors retain the right to skip a dividend if it feels it's warranted. The board of directors' role is to look after the best interest of the corporation itself, which indirectly takes care of the shareholders' best interest as well. If the board doesn't think it has enough working capital, in other words cash, it could elect to skip a dividend. Skipping a dividend is never a good sign though, and it could negatively impact the corporation's credit rating. Therefore, a publicly traded company would not make this decision lightly. So with all this in mind, let me ask you a thought-provoking question. All else being equal, would you expect a higher return, often referred to as yield, on an interest-paying security or a dividend-paying security? Keep in mind the risk-reward relationship we discussed in an earlier video. A dividend-paying security involves more risk. As we just learned, the issuer could skip a dividend, so you would expect a higher return to compensate. Okay, now that we've covered what a dividend is, in the next video, we'll talk about how they are taxed.